Okay, let's dive in. Today, we're really digging into income investing, the hunt for reliable, high yield, especially when the market seems focused elsewhere.
Right. And we're working off just one source today, an article that honestly makes a pretty bold case for one specific type of fund, a closed-end fund, or CEF.
Exactly. So our mission here is to unpack why this author is so keen on this particular fund. What's the argument? What are the details from the source that make it stand out?
Yeah, the source basically says, look, finding high, maybe even growing reliable yield is possible, specifically through these CEFs if you pick the right one.
And the big hook, the claim that really caught our eye, was the author saying a 7% yield, maybe more, isn't always a red flag, not necessarily a trap.
Right, if you know what you're looking for. And this fund they highlight, they call it underappreciated, says it delivers real income from real assets managed by real professionals. Strong words.
Definitely. So let's unpack that argument. We need to get into the specifics from this article, why the author thinks this fund works, and why it matters now.
Okay, so starting point. Why now? Why focus on a 7% yield right now? The article kind of paints a picture of the current environment.
Yeah, rates are up, sure. T-bills look good for a bit.
But maybe not forever, the author suggests, and maybe bonds aren't quite cutting it against inflation. And dividend stocks, sometimes pricey, or the yield just isn't high enough.
So the appeal, according to this source, is finding a fund that could potentially kick off serious monthly income, like, quote, without you lifting a finger. That monthly cash flow is huge for some people.
It really is. But the author knows what people think.
Yeah.
They see 7% plus yield and immediately...
Alarm bells go off, dividend trap, unsustainable.
Exactly. And the source says, yeah, that skepticism is often justified. Sometimes it is a sign of trouble.
But not here, they argue, for this specific fund.
Right. For this fund, the author lays out counter-arguments. They talk about its history, the quality of what's inside it, how it's consistently covered its payouts, and, this is important, its net asset value, the actual value of its holdings per share.
Let me guess, it hasn't just cratered?
According to the source, it's actually been rising over time, generally speaking, which directly counters that fear of the fund just handing back your own money while shrinking. The idea is growth plus income.
Okay, let's name names. What's the fund this article is focusing on?
It's the PIMCO Dynamic Income Fund, ticker is PDI.
PIMCO. Okay, that's a name people know in fixed income, big player. How does the source describe their role here?
As you'd expect, positions them as, top-tier bond managers, decades of experience. Their job with PDI, as the article puts it, is basically navigating all these complex global credit markets to find yield, manage the risks, and, crucially, cut that monthly check.
And the yield, what does the article quote?
It states a 7.6% distribution yield, and again, paid monthly.
The monthly aspect keeps coming up. What else does the source highlight about PDI's track record to support the enthusiasm?
Well, they point to a few things. A history of actually raising the dividend over time, maintaining its NAV, its value, surprisingly well even when things got choppy, like in 2022 with those rate hikes.
Interesting.
And a track record of, as the author puts it, kind of buying low, selling high within its specific markets. Smart trading, basically.
Okay, that sounds good on paper. But what's in the fund? What allows PIMCO to shoot for that kind of payout and performance, according to this source?
It's a mix. The article details holdings like mortgage-backed securities, MBS. That's kind of PIMCO's traditional playground, right?
Right.
But it's broader than that. High-yield corporate bonds, emerging market debt, bank loans, different kinds of agency and non-agency bonds. It's diversified across the credit spectrum.
So definitely not just tracking some passive index.
No, absolutely not. The source makes a big point of this being actively managed.
Yeah.
PIMCO's team is making calls, trading, adjusting. It's hands-on.
The article also mentions leverage. That word makes some investors nervous. How much are we talking, and what's the author's take on it?
Yeah, it mentions around 40% leverage, which, sounds like a fair bit.
It does.
But the author frames it as strategic, not just borrowing wildly. They argue PIMCO uses it carefully to try and capture extra yield, exploit little inefficiencies in the market.
Okay.
They use this analogy like giving a skilled driver a Formula One car instead of a regular sedan. If you know how to handle it, you can do more.
Right. Skill matters. That makes sense. So the potential for higher returns, but you need the expertise.
Exactly. Now, related to leverage is this common criticism of CEFs, NAV, decay. The idea that the fund's value just dwindles over time. How does the source tackle that?
That's a big one for CES.
It is, and the author addresses it directly. They acknowledge, yeah, 2022 was rough. Rates spiked, leveraged bond funds, including PDI, according to the source, took a hit on NAV, no denying that. But the specific point about PDI in the article is that its NAV has already started to recover since then, and maybe more importantly,
A payout.
yes. They point to the fact that PDI actually increased its distribution recently. The author sees that as a really strong signal that the income being generated by the underlying assets is healthy, enough to cover the payout without, eating into the fund's core value long term.
The source also mentioned something called UNII data. What's that about?
UNII stands for Undistributed Net Investment Income. That's basically like the leftover income the fund earned but hasn't paid out yet.
Okay, so a reserve.
Kind of. And the article points to PDI's recent UNI reports showing it's been over-earning its distribution, making more than it pays out.
That sounds positive.
It does. And the author makes sure to contrast that, saying, most typical high-yield ETFs or dividend stocks, they can't usually claim that.
Let's circle back to the monthly income. The source really emphasizes this.
Yeah, it's presented as a major plus. The logic is simple. Your bills come monthly, right?
Mm-hmm.
Mortgage, utilities, food.
Mostly, yeah.
So getting investment income monthly just lines up better. Feels more like a paycheck, less like waiting for a quarterly bonus. The author really pushes this for retirees or anyone needing regular cash flow.
Makes sense. Better for budgeting, predictability.
Yeah.
Compared to waiting 3 months for a dividend.
Exactly. Now, interestingly, the source also brings up taxes. You might think a high yield means a high tax bill, but it mentions return of capital, ROC.
ROC. Okay, that term can sound bad, like they're just giving your own money back.
Right. And sometimes destructive ROC is bad, but the author here distinguishes it. They call PDI's ROC tax-advantaged ROC. The claim is it's not coming from selling off core assets in a bad way.
So where does it come from, according to the article?
It apparently stems from accounting things within the fund, like how bond premiums are amortized, stuff like that.
Yeah.
It's generated income, but gets classified differently for tax purposes.
And the benefit?
Tax deferral. The article says you don't pay income tax on the ROC portion that year. Instead, it lowers your cost basis. So you only pay tax on it way down the line when you sell the shares. The author calls it a win for managing your current tax burden, especially if you hold it in a regular taxable account.
Okay, but let's be clear. The author isn't saying PDI is risk-free, right? They mention no free lunch.
Definitely not. The source lays out the risks. There's leverage risk. Changes in interest rates can hurt more because of the borrowing. There's credit risk. Some underlying bonds could default.
Standard bond fund risks, basically.
Pretty much. And also premium risk. PDI often trades at a price above its NAV. That premium isn't guaranteed. It can shrink, especially if the market gets scared.
So how does the author frame these risks? Are they deal breakers?
No, they're presented as calculated risks, not like roulette wheel risks. The argument is PIMCO knows these risks exist and has the tools and experience to manage them. They've navigated volatile markets before.
And they compare these risks to other investments.
Yeah, the author puts it in perspective. Like, okay, you have premium risk with PDI while collecting 7.6% monthly. Is that worse than owning a tech stock that pays nothing and could drop 30% overnight on bad news? It's a trade-off.
Fair point. Okay, so how does PDI stack up against other common income options, according to this article?
The author does some direct comparisons. First, versus something popular like SCHD, the Schwab Dividend ETF.
Good fund, lots of fans.
Right. The author calls it a great fund. Low fees, safe. But the yield, much lower, like 3.5% in the article's example. And it pays quarterly. The author's take is nice, but maybe not enough income for early retirement or fighting serious inflation.
What about just holding bonds, maybe via an ETF like TLT for treasuries?
The source is a bit dismissive there, talks about potential negative real returns after inflation, plus big sensitivity to interest rate moves duration risk. They argue PDI's active, flexible approach across different credit types is better equipped to handle shifting markets.
Another CES. There are lots out there.
True. The article suggests many others might be less transparent, maybe not as well managed, or too focused on one tiny niche. PDI is positioned as this sort of Goldilocks option. Broad credit exposure, top manager, monthly pay.
Let's make it concrete. The source uses a number example, right? A $100,000 investment.
Yes, to illustrate the income. With a $100 K investment, that 7.6% yield translates to roughly $7,600 a year, or, breaking it down, about $630 every single month. paid out without selling shares.
And how does that $630 a month compare?
The author contrasts it sharply, like SPY might give you $1.60 a month on that amount, TLT maybe $2, cash maybe $400 for now. The phrasing used is that PDI is like putting your money on payroll.
That's a memorable line. The source also mentions reinvesting those payouts.
Right. If you don't need the cash flow right away, the suggestion is reinvesting those monthly distributions can turbocharge compounding. Grow your stake faster, building up that income stream for later.
Now, the author anticipates some might find this whole idea, well, boring.
Totally. They acknowledge it. Getting a monthly check from a bond fund manager isn't exactly meme stock excitement or chasing the next big tech thing.
But for the target audience,
For them, the author argues, boring is beautiful. If your goal is financial independence, early retirement, steady income that keeps up, then something reliable that pays the bills and actually works, as the source puts it, is way more attractive.
so if someone reads this article, finds the argument compelling, when should they consider buying? It trades at a premium, you mentioned.
Yeah, the source notes that, currently around 5–6% premium. Ideally, you buy CEFs at a discount, sure. But the author views this premium as fairly modest historically, kind of a vote of confidence in PIMCO.
Any specific strategies suggested in the source?
Two main ideas. Maybe wait for a market dip that could bring the price down, potentially shrinking the premium. Or set a limit order closer to NAV and see if you get filled on a down day. And of course, reinvesting those dividends until you hit your income goal.
Okay, wrapping it up. What's the final verdict from this author based on their analysis?
The verdict is pretty clear. PDI is positioned as a get-paid-consistently fund, not, they emphasize, a get-rich-quick fund. Its main job, in the author's view, is reliable income, especially valuable now with all the uncertainty.
And the key reason summed up.
Sustainable yield, that's 7.6% monthly, top-tier management, PIMCO, diversified active global credit strategy, those tax-advantaged distributions we discussed, and a proven history of handling volatility.
So the bottom line from this source, PDI is the author's favorite high-yield pick right now, primarily because of that perceived reliability in an uncertain world.
That's the crux of it. Reliability via active management and consistent payouts.
Okay, let's do the super quick TLDR based on the source, just the bullet points.
All right. High yield, 7.6%, pays monthly, managed by PIMC, over-earning its payout currently, UNIA data, offers tax-advantaged ROC, has a track record through thick and thin. That's the snapshot.
And the article ends with a little bit of snarky wisdom, as the author calls it.
Yeah, it's a bit of a challenge, really. Asks you to think. Is your money just sitting in cash, maybe losing to inflation? Are you banking on zero-yield growth stocks? Or could you be collecting steady monthly checks from something like this?
It definitely makes you consider what reliable income means for your situation based on the perspective in this source.
And that's the idea, giving you the detailed arguments from this one specific viewpoint so you can weigh it against your own goals and risk tolerance.
Makes sense. Well, thanks for walking us through this deep dive into the source's take on PDI.
My pleasure. It's an interesting case study in active income generation.